It began with a whisper from Hong Kong's central business district, then a headline that sent tremors through global markets. Chinese billionaires liquidate $47 billion in assets, convert entirely to gold. At first, the story sounded unbelievable, an exaggeration cooked up by finance blogs. But then the evidence piled in. Private jets leaving Shanghai loaded with cargo, vault shipments booked in Switzerland, and Beijing's silent approval stamped in red. And then came the footage. Grainy security clips leaked online showing armored trucks at midnight rolling into Hong Kong International Airport, each stamped with the same 3 words: Monetary Transfer Division. By dawn, gold prices had spiked 12%, the biggest one-day jump since the 2008 crash. A CNBC anchor tried to calm the audience. This isn't a panic, it's just a portfolio shift. But behind closed doors in Washington and New York, the tone was very different. Something big was moving. And every economist with a pulse was asking the same question. Why are China's wealthiest citizens abandoning cash right now? At the macro level, $47 billion wasn't just wealth. It was confidence leaving the global financial system. The move threatened to destabilize the dollar, collapse Asian stock indexes, and trigger a chain reaction through commodities. At the micro level, it hit ordinary people. In California, Travis Miller, a 38-year-old real estate investor, noticed his Chinese buyers vanish overnight. In Texas, Olivia Hahn, a first-generation immigrant running an import business, watched shipments freeze mid-sea as banks demanded asset verification. Meanwhile, social media flooded with one cryptic phrase repeated by Chinese tycoons who'd left the mainland. Gold asks no politics. By week's end, traders on Wall Street had one terrifying realization. If China's elite no longer trusted paper wealth, maybe they knew something the rest of the world didn't. And the question hanging in the air was deadly simple. What did they see coming in 2026? The warning signs had been hiding in the data for months. Back in late 2024, China's central bank quietly reduced its holdings of U.S. Treasury bonds by $300 billion, the largest single-year reduction in history. Economists brushed it off as diversification. But soon after, an unusual pattern emerged. Beijing bought record amounts of physical gold, not ETFs. Mining companies in Inner Mongolia reported government audits that resulted in confiscation of output. Wealthy families began relocating to Singapore, citing currency concerns. And yet, the mainstream media barely mentioned it. Everyone was focused on U.S. elections and the rising hype around AI stocks. But in early 2025, a small event changed everything. The Shanghai Futures Exchange halted trading for 72 hours, officially for maintenance. Unbeknownst to most, that maintenance was the first step in a quiet liquidity freeze. The invisible threat wasn't a market crash. It was a confidence crisis, one that had already begun spreading westward. In Beijing, Deputy Finance Minister Liu Zheng chaired a closed-door meeting. The topic: U.S. sanctions on Chinese AI chip exports, and the potential freezing of Chinese overseas assets. Liu warned, if they can freeze our chips, they can freeze our money. His solution was radical. Shift Chinese billionaire wealth from digital ledgers to physical gold. Untouchable, untraceable, unfreezable. Meanwhile, in Washington, U.S. Treasury Secretary Janet Collins received an intelligence memo from the Federal Reserve's Foreign Holdings Division. The report's headline: Unexplained Gold Movements, PRC Private Sector Activity. Collins frowned. How much? The analyst hesitated. $47 billion, and climbing. In Miami, Travis Miller tried to close a deal on 2 luxury condos, but his buyers had vanished, taking millions in escrow with them. In Dallas, Olivia Hahn's Chinese suppliers sent a chilling message. Bank restrictions. Gold only. The worlds of geopolitics and Main Street had collided, and both were about to feel the same earthquake. By February 2026, the U.S. stock market rallied again. Tech giants hit new highs, AI startups flooded Nasdaq, and mainstream analysts laughed off the gold rush as paranoia. Gold briefly dipped 3%, and social media mocked the billionaires who missed the next boom. But inside global central banks, the mood was different. The Bank for International Settlements, BIS, issued a confidential warning. Synchronized gold accumulation by Asian private wealth poses systemic liquidity risks. Translation: They're running from paper, fast. Then came the countdown. Beijing announced a 72-hour capital control test, supposedly to streamline cross-border transactions. U.S. intelligence sources interpreted it differently. It was a rehearsal, a dry run for sealing exits when the crash came. And as the countdown clock hit zero, something unimaginable happened. The Hong Kong Gold Exchange halted withdrawals. That's when everyone realized. The billionaires weren't fleeing wealth. They were fortifying against something that hadn't been announced yet. Behind the scenes, one shadowy entity connected all the dots. Zhonghua Financial Trust, a state-affiliated private equity firm with deep ties to the Chinese Communist Party. Leaked documents showed Zhonghua had been buying gold not just for private clients, but on direct government orders. In Washington, some called it economic defense. Others called it monetary warfare. A tense meeting inside the U.S. Federal Reserve revealed the moral dilemma. Should America retaliate by tightening gold exports and freezing transactions to Chinese entities? Or risk letting global gold supplies drain away, undermining the dollar? One Fed official muttered, "If they corner the metal, they corner the system." No one replied. Because deep down, they all knew it might already be too late. March 2026. A whistleblower from Singapore leaked 300 pages of internal documents from Zhonghua Financial Trust. The files revealed a Phase 2 directive labeled Dragon Shield. It outlined a plan for Chinese elites to move liquid assets out of Western banking systems. 2. Convert them into gold. 3. Deposit those holdings in a new offshore clearinghouse backed by Beijing. And the kicker? That clearinghouse, called the Eastern Monetary Fund, EMF, was scheduled to launch in July 2026. In short, China's wealthiest weren't running from chaos. They were preparing to replace the Western system altogether. For decades, the dollar had been the world's safe haven. Now, a new kind of vault was rising, and it was lined with gold. The world had just entered the next phase of the currency war. By spring, the ripple effects hit home. American markets convulsed. Gold surged past $3,200 an ounce. The U.S. dollar fell 11% in 6 weeks. In Texas, Olivia Hahn's business collapsed under import restrictions. Travis watched his condo deals evaporate as foreign buyers disappeared. Meanwhile, in California, retirees saw their 401k sink while financial advisors scrambled to explain why gold was suddenly outperforming tech stocks. Cable news spun it as temporary volatility. But behind the scenes, Treasury officials admitted, if this trend continues, the dollar could lose reserve dominance within 5 years. The crash wasn't here yet, but the fuse was burning. In June 2026, a second whistleblower, this time from Switzerland, revealed something the world wasn't ready for. The Eastern Monetary Fund's gold reserves weren't being held in Hong Kong or Beijing. They were being stored in Fortress Gold, an underground vault network spanning the Swiss Alps. And half the vaults were leased from Western banks. In other words, the West had unknowingly helped China's elites build the very system that could dethrone the dollar. It was the ultimate irony. Wall Street's own gold reserves were funding its replacement. As the news broke, traders panicked. The Dow plunged 4,000 points in 2 days. U.S. senators demanded hearings. But the gold shipments kept moving, silent as shadows under a storm. And the final domino was yet to fall. By late 2026, the new global order was quietly taking shape. The Eastern Monetary Fund opened its doors with gold-backed digital notes, instantly adopted by dozens of nations tired of dollar dominance. In the U.S., inflation rose as confidence fell. Ordinary citizens began buying small gold coins, just like their grandparents did before the Great Depression. Travis turned his unsold condos into vault rentals. Olivia reopened her business, this time trading physical bullion instead of imports. The world hadn't ended. It had simply shifted. And as history repeated itself, one haunting parallel became undeniable. In 1933, America seized its citizens' gold. In 2026, China's elite seized the world's supply. Different players, same playbook. And those who didn't see the pattern were destined to pay the price. When billionaires start running to gold, it's never random. The last time this happened, we got the Great Depression. So what does $47 billion in gold mean for 2026? Are they predicting a crash or preparing to cause one? Comment your thoughts below. Because in the next chapter of financial history, The people who understand gold will survive the storm. When billionaires start running to gold, it's never random. The last time this happened, we got the Great Depression. So what does $47 billion in gold mean for 2026? Are they predicting a crash or preparing to cause one? Comment your thoughts below. Because in the next chapter of financial history, the people who understand gold will survive the storm.